Hi friends, if you look at this tweet, you will see that this person is cribbing about cryptos because he lost almost 52% of his portfolio in cryptos. Now, I'm not saying cryptos is a bad asset, but if you put 100% of your investments into crypto, yes, absolutely crypto is a bad asset. Now, have a look at this tweet where this person lost almost 5,000 US dollars in stock. Again, stocks are a very good wealth generating asset, but this guy had put in 1,34,000 US dollars in just stocks. And the last tweet I want you to have a look at is this one. This guy has hit the nail on its head because this guy is now regretting not listening to his father as he went down from a profit of 1.5 lakh to almost 60,000 of losses because he did not diversify his assets. $1 million concept that you have to practically apply into your portfolio is that do not put all your money into one type of asset. Please diversify. Only by building a portfolio of assets you can generate wealth for yourself in the coming generations. And more so if you're a salaried person, because in India, saving salary after paying hefty taxes is no joke really. Therefore, we need to invest our salary very sensibly. So in this video, I'm going to help you understand where to invest your salary for good returns while lowering your risk. Extremely important video. Please do not skip the video. You're going to learn a lot in this video. People who don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. If you want to learn investing in a very practical manner, join my YouTube member community because I post almost on a daily basis, bringing you practical insights. The feedback of this community has been excellent. Simply go to my channel, press on join button, or you will find the link in the description or in the pinned comments. With that, shall we get this video started? Let's go. Now, where to invest your salary will depend on two crucial parameters. Parameter number one is what type of investor you are. Are you a conservative investor? Are you a balanced investor? Or are you an aggressive investor? I'll shortly explain to you all these three, but the second crucial parameter is the duration of your investment. Are you investing for short term or are you investing for long term? Now, let me break down all these scenarios and give you my view as to what makes the perfect sense in terms of allocating your money. So number one is conservative. Conservative investors are those investors who have low salary income because they are only able to save, let's say 5,000, 10,000 rupees per month. And they know that this is so important for them to protect this money because they don't have a backup. Therefore, their risk appetite to lose the capital is literally zero. They do not want to lose even a single rupee out of their investments. And hence, their return expectations are also lower naturally, and therefore they're expecting somewhere between 7 to 12% of annual returns. So if you're a conservative investor and want to invest for short term, which is up to 3 years, the sensible allocation in my view is do not invest more than 20% of your money in equities. So 20% is fine. And within equity, the best option for you is go for a Nifty 50 index fund because it is very cheap. And secondly, it is the least risky asset when it comes to equity investing. The remaining 80% of your investment should be in a fixed income instrument like a fixed deposit. Now you may have a natural question that Rahul, 80% of our money if we park in FDs only give returns of 6 to 7%. See, nowadays fixed deposits are also giving returns up to 9.5%. But a lot of people don't know which banks are offering up to 9.5% of interest rate. For example, if you go to stable money platform, you will find two banks, Unity Bank and Northeast Bank, that are giving 9% interest rate for the normal people and 9.5% interest rate for the senior citizens. In fact, fixed deposit in Northeast Bank with 9.5% rate for a tenure of 3 years, you get a total interest of 32.5%, and that gives an annual yield of about 10.84%. And these high interest FDs are safe because up to 5 lakhs of investment in these FDs is insured by DICGC, which is a subsidiary of RBI. And this 5 lakh limit is per user per bank. And with stable money, you can book your FDs with multiple banks without opening a savings account with them. So in a month, if let's say bank A is offering you high interest rate, you go with bank A. And if next month bank B is offering you high interest rate, then you put your salary into bank B without having to open a savings account with any of these banks. And here's the best part. There are a few banks on stable money that are allowing to instantly withdraw the money if there is an urgency for you. So tech platforms like stable money are changing the way FDs are done in India. If you haven't yet tried Stable Money app, give it a go and compare more than 200 banks FD rates in just a matter of few clicks. The link is in the description or in the pinned comments. Let's move to the next option, which is if you're a conservative investor and if you want to invest for long term, which is more than 3 years, then your allocation should be FD 50%, equities 40%, and in that Nifty 50 index around 20%, mid cap mutual funds 10%, small cap mutual funds 10%, and gold 10%. When it comes to gold, I like gold ETFs. So I personally would recommend you to explore gold ETFs. I've created videos on gold ETF on my channel. You will easily find them and you will understand the ABC of gold ETFs if you're not familiar yet. Now, why 40% in equity? Because you're investing for more than 3 years of time, and equities are likely to perform and give you good returns if you hold them for 3 years of time. Now, you may have a counter argument that, Rahul, if that's the case, why would I not put 80% money in equity? Because you are a conservative investor. Please understand that equities are very, very volatile and they may all of a sudden fall. Market may crash, market may correct. And since you are a conservative investor, you have zero risk appetite. You are going to struggle with the volatility and you might exit your equity portfolio incurring huge losses. That is why I'm saying FD 50%, equities 40%, and gold 10%. So if you're a conservative investor, let me know in the comments that, Rahul, I'm a conservative investor and here is my allocation in terms of the portfolio. Let's share that so that more and more people can pool their brains and we can learn from each other. With that, let's now move to the balanced investor, the second category. So balanced investors are those investors, they say that, Rahul, we want to make a little bit more money, right? We want to have returns of 12 to 15% on an yearly basis, and we are okay to see some capital loss of, let's say, up to 5%. So we have some risk appetite. So if you're a balanced investor and want to invest for, let's say, short term up to 3 years of time period, then in my view, the allocation that will make the most sense is fixed income, which is FDs 50%, and the remaining 50% in equities in the proportion of Nifty 50 index 30%, mid cap mutual funds 10%, and small cap mutual funds 10%. Now, 4 quick points I will make about this allocation. Number 1 is, with this allocation, your chances of making losses is going to be low. Point number 2 is that you might see your portfolio going down because you've got 50% exposure to equities, but please understand, as long as you hold it for up to 3 years, the chances of losing money is less, and also you have risk appetite of seeing portfolio down by around 5%. Point number 3 is that you might say that, Rahul, why not invest in individual stocks? Well, because individual stocks are very, very volatile. You might see a particular stock coming down by 10%, 15%, 20%, and your risk appetite is only up to 5%. So you are going to not sail through when the stock is falling. Fourth and the last point I'll make here is that please don't do any fancy thing if you're a balanced investor. This allocation makes a lot of sense. Stick to the basics here. Just a disclaimer that I'm not a financial advisor. I am giving you these broad frameworks, but your situations may be entirely different. So please make sure you consult with your financial advisor before taking any decisions. Now moving to the next scenario, that if you're a balanced investor and if you want to invest for more than 3 years of time horizon, which is a long term, then in that case, fixed income or FD is 20%, equities 70%, and within that Nifty 50 index is 20%, mid cap mutual funds 20%, small cap mutual funds 20%, and 10% allocation for individual stocks that you can pick from Nifty 500 universe. And finally, 10% allocation to the gold. Let me quickly make 3 points here. Point number 1 is that here we are allocating 70% to the equity, but please make sure that you keep your long-term vision, long-term duration of your portfolio intact, because if in the short term markets fall, please do not panic and make sure you continue to remain invested because you're investing for long term. As long as you invest for more than 3 years of time, you are not likely to see much losses. You are going to in fact gain if you stick to this allocation, which is Nifty 50 20%, mid cap mutual funds 20%, small cap mutual funds 10%. Second point is that I am not suggesting more than 10% of your allocation to the stocks because you are still a conservative investor. And if you end up picking bad stocks, your portfolio may go down more than 5%. That's why I've kept the allocation to only 10%. And the third and the last point, that within these stocks, please make sure you pick up from 2 or 3 different sectors like IT, FMCG, pharma, etc. Now, let me know in the comments if you are a balanced investor and what is your portfolio allocation right now. Please share it so that more and more people can join in and understand what other people are doing. Where is their head going in terms of investing their salaries? And so far, if you're liking this video, give it a like now and let me know in the comments a simple thank you. It motivates me to create these videos for you at zero cost. Let's move to number 3, which is aggressive investors. So these are the investors who are saying that, Rahul, we want to make money or generate returns, which is 15 to 20% on an annual basis. And we are okay to see our portfolio go down by, let's say, 15% if it comes to that. So they have a higher risk appetite, right? So in these cases, if you're investing for short term, then the allocation that makes more sense is fixed income instruments like FD around 30%, and then remaining 70% can go in equities in the ratio of, let's say, Nifty 50 index 20%, Nifty 500 stocks, like picking individual stocks up to 20% of your portfolio, strategy mutual funds 10%, mid cap mutual funds 10%, small cap mutual funds 10%. Now, 3 quick points that I want you to understand. Point number 1 is that you may say that, Rahul, why 30% allocation to FDs even if you are an aggressive investor? This is because this is a short-term investment, right? And if you're already putting 70% of your money in equities, what happens if market all of a sudden falls, like a COVID situation comes, market is down by 20%. If a war situation comes or something unknown that comes and your portfolio goes down by around 30%, 25%, in that case, it is going to create panic in your minds. Therefore, having 30% of fixed income will provide the backbone to your portfolio, which will remain stable. Point number 2 here you will see is the strategy mutual funds. What are these mutual funds? So these are the smart beta or factor mutual funds. I've spoken about these on my channel. For example, momentum mutual funds. For example, value mutual funds, volatility mutual funds. You will find these videos on my channel. Please go and watch them. Also, if you have not yet subscribed to my channel, what are you doing? Please go ahead and hit the subscribe button. You are going to learn a lot. And third point here is that you can go and pick up good stocks. Let's say around 20% of your portfolio can go into the direct stocks because you have a risk appetite of seeing your portfolio down by almost 15% if it comes to it. So far, if you're finding this video useful, hit the like button. Also, if you practically want to learn, you can consider joining my YouTube member community. I post almost on a daily basis, and with those posts, you are going to practically learn. The feedback has been very, very good. Go to my channel, press on the join button and be my guest. With that, let's move to the last scenario, which is if you're an aggressive investor and want to invest for longer than 3 years, long-term period. In that case, fixed income instruments like 10% in FDs, 80% of your money can be put into equities with the allocation, which is individual stocks from Nifty 500 universe, which is around 40%, strategy mutual funds around 20%, mid cap mutual funds 10%, small cap mutual funds 10%, and finally gold ETFs 10%. Now, 3 to 4 quick points here. Point number 1 is that even though you are an aggressive investor, I say that go for 10% of money into fixed deposits because this will act as a cash position for you whenever the markets fall. And in fact, on stable money, there are a few banks that are offering the instant withdrawal facility. So it will help you to keep some money in the FDs so that whenever you need to withdraw the money and put into a market, if the market corrects, that 10% is waiting for you to do that while earning up to 9% of interest rate. Second point is that if you are an aggressive investor and are having a time horizon of more than 3 years, up to 40% of your money can be invested in the good long-term stocks that can generate good wealth for you in long term. Please don't be greedy. Please don't put all of your money into individual stock, even if you're an aggressive investor and have a time horizon for more than 3 years. It is extremely risky. So please make sure you have a good allocation to different assets. Lastly, strategy mutual funds. I'm allocating 20% here because these mutual funds have given better returns than Nifty 50, for example. And I've kept mid cap and small cap to 10% each, which makes a lot of sense in my view. See, the whole idea here is to balance the risk and returns based on your risk appetite. Just a disclaimer, none of these returns that I've spoken about are guaranteed returns. These are the expectations you can have. I cannot predict the future that you are definitely going to get these returns. The last point that I will make here is that please make sure that you are rebalancing your portfolio almost on a 6 months basis, because sometimes what happens is because if your stocks are doing well, your portfolio will naturally see higher allocation automatically into stocks and you want to avoid it. So please make sure every 6 month basis you're looking at your asset allocation, balancing it, rebalancing it to make sure you remain as per your asset allocation. Finally, for FDs, Stable Money is an excellent platform. You will find the link in the description or in the pinned comments. Please go and check it out. I hope you enjoyed this video, you liked this content, and if you did, hit the like button. Let me know in the comments a simple thank you. I will see you in my next video. Until then, keep rocking.